what is the Wallaby? Once again, the Wallaby is a combination of three stochastic oscillators. It's not the Holy Grail. It's not invented by Jesus or the apostles or anything like that. And yes, I am still little. Here's Wallaby version 1.0. Wallaby version 1.0 was a bunch of wiggly lines on the bottom of a MetaTrader screen or a TradeStation screen. And each one of those lines that you see there in that square blue area is a stochastic oscillator from one time frame chart. Here's Wallaby version 1.5. I took those three lines and averaged them and then put a thick, dark, black line on the chart to make it a little bit easier to see. And then Wallaby version 2.0 is just that average line. That is the average reading of three stochastic oscillators, one from the 1-minute chart, one from the 5-minute chart, and one from the 15-minute chart. Here's what you need on your charts to follow what we're going to do today. You need some moving averages, you need a stochastic oscillator, and you need the Wallaby indicator. I'll show you what those moving averages are and what that stochastic oscillator is right now. The 800 simple moving average is black and white. It's my favorite moving average. The 200 simple moving average is blue. The 62 exponential moving average is red. The Wallaby indicator is black, and it's in the middle there, and it's set to 733. And the stochastic oscillator is set to 30, 10, 10. All right. The Wallaby indicator is viewed on one time frame chart. You already probably knew that, meaning you put the Wallaby indicator on, let's say, your 15-minute chart. If you put on your 15-minute chart, you'll be looking at the stochastic oscillators on your Wallaby indicator from three time frames, all on that one 15-minute chart. And we're going to take a look at that in a few moments, but that'll start us off. All right. What is divergence? Divergence is when price goes one way and your oscillator goes the opposite way. So if price is moving up, but your oscillator is moving down, that, my friends, is divergence. Here's an example of bearish divergence. Price is moving up on the picture in front of us here, but the Wallaby oscillator indicator is moving down. What that means is the average of three stochastic oscillators from three different time frames is divergent against price. And that's more powerful than if just one stochastic oscillator from one time frame chart was showing divergence. Why do I use the Wallaby instead of the relative strength index or the CCI or something like that? Although the Wallaby oscillator indicator will show divergence at the same time as the CCI and the RSI and other oscillators, the momentum indicator and so forth, it is true that the Wallaby indicator, because it's showing three time frames all at once, will often show divergence when another oscillator will not. And so it will get us into trades sometimes when we want to be in one and would not have otherwise seen the divergence. It's also true that sometimes the Wallaby will not show divergence when another oscillator will show it. We want to avoid the trade, and we do so because we've seen it on the Wallaby. Divergence is also when price is moving down and the oscillator is moving up. That's bullish divergence, and here's an example on a chart. Bullish divergence in this instance is when price is moving down, but the Wallaby is moving up, and it's an early warning sign that this currency pair may turn around and go up. And it's only an early warning sign. It's not, obviously, a guarantee. Here's an example example of what a Wallaby trade looks like from February 28, 2011. On the far right-hand side of this chart, you'll notice that price is moving upwards, and I've drawn a trend line across the top of those candles. And the Wallaby oscillator is dropping. It's making lower highs across the same time period. You can see at the far right that the stochastic oscillator set to 30-10-10 is crossing over, making a bearish crossover on the right-hand side of the chart. And that is the entry on a Wallaby trade. Let's take another look at this and show you what the stop loss would be. The stop loss goes above the recent highs, and it's a tight stop. In most cases, this stop loss will be at least 2 times smaller than your profit target, and in some cases, much smaller than that. So that's where the stop loss goes, as tight as possible. And the profit target can be a recent low, can be a set of moving averages, can be a trailing stop. What I'm going to talk about using today is the 200 period simple moving average or the 800 period simple moving average. Both of those are my favorite profit targets for this trade.